Hi traders, Ken Calhoun from TradeMastery.com here with another indicator episode. How many times have you ever struggled with figuring out if the stock market has a strong versus a weak long or short bias? It's really important, especially for intraday trades, but also for figuring out whether or not to pull the trigger on a swing trade. So we're going to look at the ARMS index, also known as the TRIN, in this week's episode, designed to help you figure out how strong of a long or a short bias the stock market's having. That can be extremely helpful to help you figure out whether or not you should be trading in the first place, and number two, how many shares or contracts or lots that you're trading. So let's take a look at how that works. The TRIN coming right up. Now, I first heard about the TRIN in my colleague Tony Turner's excellent book, Beginner's Guide to Day Trading Online, back in the year 2000, and highly recommend that book. What I found is that the TRIN is especially useful as a discipline tool to help me figure out if I should be aggressive long or very tentative long or aggressive short or tentative short based on its strength. First of all, what is the TRIN or the ARMS index? You can Google it. But to just go through quickly what it is, it's the ratio of the advanced declining number of issues over the advanced declining volume. So basically it gives you a really good visual roadmap of the overall market bias, if it's long or short. And it's an inverse indicator. When the market's at rest, kind of at equilibrium, the TRIN reads 1.0. And it's an inverse indicator. So the higher the TRIN reading is, the more short bias the stock market is. So I use 1.5. 1.5 is kind of my threshold for a strong short bias in the market. And that's very useful starting at the opening bell at 9:30 to check your TRIN readings and see if there is a strong short bias or a strong long bias on the open. Conversely, if the TRIN is under 1.0, and especially if it's under 0.7, it's kind of the threshold value that I use, that tells me we've got a relatively good, strong, healthy bias in the market. This can also help you avoid false breakouts. What I found from experience is if the TRIN is hovering near 1, say 0.9, 0.95, 1.0, 1.03, 1.1, something close to 1, the market is relatively uncertain. Even if the visual pattern, if you're looking at your S&P or your Nasdaq chart, you may be uncertain. It may be in a congestion zone. So be sure to double check your TRIN reading to tell you whether or not there's a long or a short bias in the stock market. And that really helps. So for example, when I'm looking for putting on long intraday trades, if I'm looking at trading the open range breakouts or a good gap continuation, I prefer to see the TRIN down at say 0.6 or 0.7 or lower, which tells me the bulls are firmly in charge from a momentum trading standpoint. So using the TRIN is especially useful to help determine the overall long or short bias of the market and how to trade. So you're kind of trading like a market chameleon, or you're adapting your bias as a long or a short bias or a stand clear bias trader based on the reading that the TRIN gives you. Now take a look at these upcoming few minutes captured from my live Trading the Open Room a few days ago, where I explained the TRIN with real-time data and everything to help traders see the difference between how to use the TRIN for long versus short markets. One of the most important indicators that you will learn as a professional day trader is to use the ARMS index. Originally created by Henry Arms back in the late 60s, the ARMS index is a ratio oscillation indicator of the advanced decline line and the up in the AD volume, and basically it's just an indicator that shows bullish versus bearish sentiment. It's updated every 30 seconds starting at the opening bell, and under 1 is a bullish or long bias, over 1 is a bearish or short bias. So if you saw this TRIN, what would the market, this was captured yesterday, but this every 30 seconds these were the readings. What would this indicate to you? Would the market be a long bias or a short bias if you saw 1.5 given this? All right, Richard, it's a bearish short bias. So anything over 1 is at equilibrium. And I use it as also as a discipline indicator. If the TRIN is right near 1, I've got to have a really strong outlier stock, either a news or momentum breakout stock or a gap continuation or a very strong wide range chart to focus on. If the trend is over 1, I don't want to do a lot of long trades. And if the trend is under 1, I don't want to do a lot of short trades. I want to go in trend of the trend. And along with the VIX and the tick and the futures and the rest of it, it's one of the core indicators that you want to make part of your approach as a professional trader. So the ARMS index, also known as the TRIN, is especially helpful in determining the overall market sentiment at any point in time. And it's really good to keep an eye on the trend reading to help you either have a bullish, a bearish, or a neutral bias in the stock market. As a update, there is 2 trends. There's one for the New York Stock Exchange, known as the TRIN, like this. There's also one for the Nasdaq with a Q on the end of it. In context of a professional trader's workstation, you can see we've got them parked down here. This is the Nasdaq trend. Again, this does not update until the market opens, and currently we're at 9:18 in the morning. But you can see we often have a divergent trend. This is the Nasdaq trend with a reading of 1.56, which is bearish. Simultaneously, we have a long trend bias in the Nasdaq market, which is 0.5. So often they will be divergent. This becomes especially helpful when it comes to identifying which markets to trade long. So if, for example, you see a long bias in the Nasdaq market, you might want to give more weight or emphasis to long trades in that market rather than the stocks found in the New York Stock Exchange. So it really helps from a scanning standpoint and a market bias standpoint. It's something I've used since the 90s, and it's a very helpful indicator to give you broad market sentiment. It's an oscillation indicator, and again, in market starting at 9:30, it updates every 30 seconds. So that gives you a good professional read on what the market's doing and how volatile it is. Chart. If you look at our trend readings, you can see the Nasdaq trend, denoted by a trend with a Q, is break even. So that means it's not a good time to trade anything in the Nasdaq. The New York Stock Exchange trend is a short trend. It's over 1.3. It's north of 1. It's over 1. So for that reason, it says we got a short bias in the New York Stock Exchange. And you can see that's supported by this move down in the spiders. And so you see a corresponding short trend reading in the New York Stock Exchange trend. Now, I'm not a big fan of visually looking at the trend charts because they're oscillators. So they just kind of chop up and down. So it's not particularly strong. Here's the New York Stock Exchange trend chart for today. You can see it's been trending up as the market's been selling down. Okay, and our Nasdaq trend chart is parked up here just north of the 1 break even. Currently it's right kind of sitting on the 1.0. Now it's starting to head up. Do you see how the trend reading is moving up over 1.2? That means that sellers are coming into the Nasdaq market. So we got a slight short bias Nasdaq, and also a decent short bias in the New York Stock Exchange. So this is the Nasdaq trend with the trend Q. You zoom in on this, you see it's headed up. So this goes up when the stock market goes down, and vice versa. And same thing with the NYSE, the NYSE trend. It goes up when the stock market goes down. I'm going to bearish engulfing here, but anyway, it's over 1, so it's still in bear territory. It's still in bear country. So we've got short biases in both the Nasdaq and the New York Stock Exchange trend. And if you take a look at the spiders, you can see that's supported by this 6-minute downtick in the S&P, with the spiders instrument moving down the last 6-7 minutes. So you should, as a trader, the reason I like to use the trend is it's a good kind of a discipline, or at least directional indicator, to tell you which way the market is oscillating up or down. And you could check in with it every few minutes to see, hey, do we have a strong long market, which would be, say, trend readings under 0.7, which we don't have right now. Or is it a bearish market, say over 1.5 or so, which we do have in the New York Stock Exchange, but not yet in the Nasdaq. So your trend readings give you a real-time dynamic look at bullish or bearish bias in the stock market. And that is helpful to help you determine, at least I use it for determining initial share size in my instruments, and that really helps. You could see, for example, I like to trade the VXX. I'd called it long at 32.6. That's in the money now. You're welcome. Sell half now for a quick scalp, trail a stop at break even on the rest. It's all good. And the reason the VXX is going up is these guys are over 1, 2. So often what you'll see is convergence. You're looking for divergence and convergence in the market to evaluate relationships between the variables. And you can see the ARMS indices, the TRIN readings are bearish right now for both the Nasdaq and the New York Stock Exchange. And correspondingly, the VXX, which goes up when the stock market goes down, is also up. So you'll always see, or virtually always see, the VXX go up when these instruments go up, when they're over 1. So that's one way that I like to trade, at least using the TRIN readings, is trade the directional VIX instruments for bearish signals. So that's one more way to use the TRIN to help stay on top of things when you're looking for bullish and bearish biases of the market. And just again, a reminder, here at Trading the Open, our ARMS index, the TRIN, it's an oscillation indicator that shows bullish versus bearish sentiment. Under 1 is a bullish or long bias, and over 1 is a bearish short bias, like we're seeing in today's markets. All right, and that'll wrap us up for today. Another quick note is there are separate trends. To make it a little more complicated, but you need to know this. Visually, there's separate trends or ARMS indices for both the Nasdaq and the New York Stock Exchange. Typically, the ticker symbol for the Nasdaq TRIN is TRINQ, whereas the symbol for the New York Stock Exchange, the main TRIN, is TRIN. And sometimes they're divergent. You may have a long market bias in the Nasdaq and a short market bias in the New York Stock Exchange, or vice versa. Or they may agree with each other, either long or short. So do visually keep an eye on the different TRIN readings. And the way I do that, as you saw in that video, is I have a small TRIN box for both the Nasdaq and the New York Stock Exchange TRIN available to me. It's really important information to help me stay clear of or trade less aggressively if the TRIN is hovering near 1, because neither bulls nor bears are firmly in charge with that AD line. So that's why using the ARMS index correctly is especially useful for intraday trading, but also for swing trades. So again, for more on intraday trading, be sure to visit my live trading room at tradingtheopen.com. That's www.tradingtheopen.com for intraday traders. I'm sure you'll learn a lot about professional entries and exits in that room experience. I run it like a live day trading seminar 3 days a week. Or if you're a stock swing trader, be sure to visit swingscans.com. That's www.swingscans.com. So if you like this video, give it a thumbs up, share it with a friend, feel free to post it on social media, and wanted to wish you the very best. So until next time, trade with intelligence, with real tight stops, play the field and trade wide, not deep, and best wishes for success in your active trades.